So we are guests of James and Pierce today. They're with Wachovia, and they've kindly let us use this room, and I know food is on the way as well, so we can get some lunch. And it's very interesting that we have a mix of professionals and investors in here. I think that this is such a new thing to many of us. Anita, I know that you've been through this cycle a couple times, so I'd love to hear your perspective on this as we go through it, as to how this differs from previous experiences you've had. Because, you know, for a couple years for the realtors, it was like shooting fish in a barrel. I mean, if any of you were buying during that time period, you were lucky if you made 10 offers and, you know, they were $40,000 above asking price if you just got the seller to even look at your offer. So we've really swung in the other direction, and I think that, I know that I, as a real estate broker, and I'm sure that many of you are trying to figure out exactly how to navigate this new market because it's very different. So we're all kind of in the same boat. You know, I'll tell you a bit about my background, but I'm not going to pretend to be the be-all, end-all expert on foreclosures and auctions or anything like this, because I think a lot of us are trying to figure it out as we go. So my goal really is to have a very collaborative, you know, everyone please share your expertise. We have some people in the room, like Charlie Parrish, for example, is a very well-known auctioneer in the Baltimore area. So I'd love to get Charlie's thoughts on this as well as we go through it. But really, I'd like to have more of a conversation than just me talking to you, because I think we all have something to contribute. Also, I am taping this. We're going to be putting it up on a couple different sites, on our site, but also on YouTube, which interestingly enough, the last 2 auction videos that I've put on YouTube have gotten between 2,000 and 3,000 views each. So there's a lot of interest nationwide about this. So it's not going to be just us in the room watching this. There'll be many, many people nationwide that'll be getting some information out of this. So let's get started. I'm just going to give a brief plug for my firm, Reo Real Estate, Inc. Our goal is to help buyers and investors make smart decisions. My motto is that you have many real estate options. They can be more complex and extensive than you realize. So we want to help you evaluate and maximize your personal and investment goals. And we do that, a lot of that, through the use of technology, which you'll see a little bit today. The agenda, let's meet Jane and Bob, which are fictional characters that we've created to kind of encapsulate what a lot of people who are going through this issue have been dealing with. We're going to talk about the foreclosure process. Pierce is going to talk about financing options. James is going to speak specifically to investments with foreclosures and auctions. And the food has arrived. So as soon as it gets set up, we'll take a quick break and get some food here. I've got some bios here. By the way, I don't believe in handouts because I'd rather that we all engage and talk, but if you email me or I will email you, I will send you a copy of this presentation. So you will get a copy of it, okay? So Jane and Bob, for those of you who are realtors in the room, you probably know their position. They bought in 2004, 2005 at the height of the market. You can see they're pretty upset because they can't afford their mortgage, their arm adjusted or something like that, and now you know, their monthly payment is a lot higher than it was. So what's going to happen to them? Well, here's the process, and we're going to spend some time on this slide. The first thing that happens, that may or may not happen, is a short sale, then a bank foreclosure, then a courthouse auction, then the property goes to REO, and finally it goes, if it can't be sold as an REO, a bank auction. So what does all that mean? Who wants to give me a definition of a short sale?
I believe it is the bank cannot recoup what their mortgage is owed to them.
Okay, so, but it usually starts from the seller's perspective. I mean, that's right, but it starts from the seller's perspective where the sellers can't sell the property for what they owe. Now, a short sale and a foreclosure are not necessarily dependent on each other. You can have one without the other. For example, if I bought a property for $500,000 in 2005 and I financed 100%, I know very few buyers were financing 100%, right? But these people did. So let's say that I did an 80% first trust, a 20% second trust, but the property is only worth $425,000 now, and I need to sell it. Either I have to bring that $75,000 plus closing costs to the settlement table, which, by the way, I have had clients do. I have had clients set, you know, if I'm especially representing the buyer and we negotiate a killer deal, the seller sometimes is coming with a check now. I mean, I've had sellers come with checks of $50,000 or more. if they can do that, they don't have to do a short sale because they can cover the difference. But if they can't, then they have to say to the bank, hey, I know I owe $500,000 here, but I can't sell it for $500,000 and I don't have the cash to make up the difference. So that's a short sale. I hate short sales, and I'll tell you why. Short sales are very, very difficult because the banks typically take a long time to respond. Here's why. Let's take this example right here. So the property is worth $425, and James comes to me and he says, Daniel, I want to buy this house, so let's offer $425. Although we'd probably offer a little lower, but let's just say that we offer $425 for ease of math. So the seller has already talked to his bank, and the bank has said, okay, we're going to authorize a short sale. Let us know how much the contract is that's presented to you. So Jane and Bob get a contract presented to them for $425. Well, they have to take it to the banks. And now we have an issue where we have a first trust holder and a second trust holder. The first trust is $400, the second trust is $100. Let's say they're with two different banks, which commonly happen, right? Second trust might be with a different bank. So the first trust says to the second trust, you know what? We got an offer of $425. I'm sorry, you're out of luck. You're going to have to take a bath of $75,000 on this property. And the second trust lien holder says, I don't think so. And so they argue, and they have to negotiate. And it's like a game of chicken, right? Because all that the second trust holder can say is no. But if he says no, he knows that it's probably going to go through this whole cycle, and it's probably going to sell at, as an REO or at auction, and then it's probably going to sell for less, and he might get nothing in that case. But that's his wild card. He can block the sale at this point. So, it's a very complex, game of negotiating back and forth.
Why would he do that?
Why would he say no at this point?
Just so he can get what he wants right then?
That second trust holder's responsibility is to recover as much of that $100,000 as he can. And if the first trust holder isn't taking any loss and is putting it all on the second trust, he doesn't like that. He wants the first trust to share in the pain. So there's this process. I've seen some banks take as long as 3 months to respond to offers for short sales.
In addition, the second, like he said, some of his clients bring money to the table, they're going to do everything they can to look at that owner of the property, see if there's any other resources available to have them not have to take a short sale. They're going to go through an evaluation process of that person to see, they have 401k money, they have anything that's not protected that they can get after.
And in fact, yeah.
Can they go
Other
after
properties.
other assets that an owner has?
Some of them are protected, I believe 401k and pension things are protected, but cash and banks and things, certainly, they're going to ask you to fill out a financial statement.
And the bank can always say no. The bank can say no, we're not going to accept this contract. So the bank holds the, Now if the bank says no, can the seller still sell it?
Yes.
If he can come up with the cash,
Yes.
right? So it's not like the bank's keeping the seller from actually selling the property, but the bank is saying, no, that offer's not going to work for us, so you got to figure something else out. On our site, we have a very extensive knowledge base with hundreds and hundreds of questions that we've gotten from buyers. In that knowledge base are the actual documents that Pierce is talking about that the seller has to fill out to start a short sale. So if you're really curious about this, that the seller has to fill out, you can take a look. Go ahead.
If the bank says no to that contract, the seller is still obligated to do something. But if the seller cannot absolutely come up with everything and they go 4 months without making a payment, the bank is going to foreclose.
Yeah, exactly. That's why short sales tend to precede foreclosures, but they don't have to. You don't have to try to do a short sale before your house gets foreclosed on. That's the seller's option, is to do that. It often happens because the sellers are hoping to get something out of the property and, more importantly, not get a hit on their credit from the foreclosure.
Something that happened previous to this before the market's really changed was a deed in lieu of foreclosure. You call your bank, and that kind of fits maybe a little bit before. Sign over the deed, just say, hey, I can't make my payments, or I can't sell the property. There's people out in Florida right now having a big problem with that, where the property's in the market for a year, and they've dropped the price, and can't sell it. So, the first thing is to call the bank and see if they'll take that. But in this market, they're not going to. They'll either try to restructure your debts and ask you to pay a different amount off, or they'll maybe even push you towards a short sale because that's even cheaper than a foreclosure.
But when they sign over the deed, does that prevent them from having something on their credit report?
It's It's possible, but more than likely, it's still going to show up as because there's a question on your mortgage application, have you had a deed in lieu of foreclosure? Whether or not it shows up on your credit report is going to be something you work out in your agreement with that actual lender.
And my understanding, I'd love feedback on this, my understanding is that if you have a short sale situation that will show up on your credit report, but it's not as bad as having a foreclosure on your credit report. Yeah.
One of the benefits that I've found for the banks in doing a short sale is lower attorney fees if they go into a foreclosure. I don't know if it's $5,000, $10,000, $20,000, but there is some benefit of cutting that part out. But I've also heard on the flip side some tricks that banks do, including pretending like they're going to approve a short sale as long as you keep on making your monthly payments. So then they drag it out another 4 months, get another $1,000, $2,000 per month out of the person, and then at the last second say, we changed our mind, but they were able to pocket another $8,000, and they're $8,000 ahead, and their boss is $8,000 happier than zero.
Right.
And then the third thing was that there have been instances where the first trust or the loan has some sort of mortgage insurance. So this one lady I heard said after 100 days of calling the bank twice a day, was never getting a response, and then I mentioned this insurance, and she goes, you know what? They do have mortgage insurance in the first, so then I believe that means that they're financially better off doing a foreclosure because the mortgage insurance covers in the case of foreclosure, but the mortgage insurance does not cover them agreeing to sell the property for $100K less, so they're pretending, to just pretending to be slow to getting back. They're getting the monthly payments, and they're getting this insurance if it goes to foreclosure. So it's very tricky to know, the exact situation, and that's why I'm here, is to better understand those tricks and when you're being had by the bank.
My understanding of the market as it is today, when I represent buyers, I do not recommend that buyers do short sales right now, mostly because of the time frame. Because as a buyer, it's very frustrating for you to put an offer in and not hear back for a month or 3 months. And that keeps you from really being able to execute a strategy where you can consistently make lowball offers, which is something else that we can talk about if you want to hear more about that.
And one quick thing, I also found out that only 50% of short sales that are under contract actually ever go to closing. So the bank changes their mind. So one thing is 3 months, another thing is just 1 time out of 2, it just does not happen.
Right.
So that's that doubles the frustration.
I imagine that as banks get through this process and become more efficient with the negotiation piece, which has to happen, that 6 months, a year from now, it may be easier as a buyer to purchase a short sale property. But right now, the juice isn't worth the squeeze, as James likes to say.
I can't blame the banks though, because if they can't recoup money that they've loaned somebody, why should they sell it for less than what somebody said that they would be obligated to do?
Yeah, and it's, there's also this tax issue where if you do sell for less than your mortgage is owed, that's considered income. It's called phantom income. So I don't know if you've heard about that, but to the seller, to the owner, if I owe $500,000 on this property and I end up getting a short sale where it sells for $425,000, either one of 2 things is going to happen. The bank is going to make me sign a promissory note that I'm going to have to repay it over time, like a loan, or it's going to be, if it's forgiven, it's going to be considered phantom income, and I'm going to have to pay taxes on that income.
So,
Yeah, it's crazy, right? But the idea is that they are, getting relief from that obligation. So I've heard that Congress may be changing that, but as of today, that's how it works.
At what rate?
I imagine it's at their tax rate, but I'm not a tax attorney, I don't know.
Yeah,
Now, James?
it's 1099.
Yeah.
Oh. Oh,
you know
wow.
what would be beneficial to the bank, and I thought about this, but I don't know if they would even do it. If somebody's on their arm that's about to adjust, and the seller has been able to make the payments on the original agreement, I would, if I were a bank, have them sign an agreement that within 6 months the house was sold, and I'll leave the payments as is, so that the income is there and the house will have a good chance to sell.
There's a lot,
That's going on.
yeah, there's a lot being figured out right now. It's very complicated because those loans are packaged up and securitized. So they're packaged into 1,000 loans and then sold on the secondary market to Wall Street. So changing the terms of the loan is very difficult. But albeit still, something's got to give, and banks don't like being in the business of owning property. In fact, federal regulators don't let them own more than a certain percentage of property on their books. If they do, they can't make new loans. So the banks have an incentive to get these properties off their books, which, I heard one banker tell me, if you catch a bank at the right time in a foreclosure, they might give it away just to get that property off their books so that it allows them to continue with their primary business. I haven't found a way to figure out when that magic moment is, but there might be a way to do that. That would be great.
Time is coming here in the next
Yeah.
to a year.
Yeah, exactly. So before we continue, do you want to grab some lunch? There's food here. Go ahead and get up and just grab a sandwich, and then if you want, while you eat, I can continue. So the auctioneer is here, and he's requested that I respect. While you guys grab some food, I'm going to show you a little piece of a video that I took from a courthouse auction. Okay, the audio is only coming from my computer, so I don't think it's going to really be loud enough for you to hear, but I'll kind of narrate this. This was just several weeks ago. I went to the Alexandria and Arlington courthouses trying to actually capture an auction, and I went 2 or 3 times and the auction didn't happen. So the way it's supposed to happen is a notice is put in the newspaper that the property is going to auction, but the seller can pay their outstanding debt a minute before the auction starts and the auction's canceled. So for those of you thinking about buying at auction, it can be kind of a frustrating process. Watch. And I think the clip that I have here is where the property that was being auctioned was a different property than the one that the buyer, the only person who showed up to the auction, there was one person who showed up, was planning on bidding on a different property, but that's not the one that ended up being auctioned, so he was frustrated.
Not show his face, his front profile, so I'm going to do my best not to.
So this gentleman is the auctioneer.
You'll notice that
He works for Samuel I. White, which is a law firm. They handle many of the auction properties. This is the only guy who showed up for the auction. So empty courthouse courtyard, completely empty. And I was speaking to the auctioneer afterwards. He said that many times nobody shows up. And he's just there reading the document to an empty courthouse. It's unbelievable.
no competition. Not a bad option.
So what happened?
I'll show you.
It's difficult to understand what happens next. Basically, the property that Bill, the gentleman who's there, came to buy is not the property that's being auctioned.
So I'm saying that the property that he came to buy was not the property that ended up being auctioned. So he's just realizing this here. He has his newspaper clipping right here from the property that he thought he was going to be bidding on. And he says it was probably canceled. That's what the auctioneer said. So if you want to see the entire video, it's a 27-minute video of, all this exciting stuff. You can go to jordio.com/auctions, and the entire video is there. Let me just, while we're talking about this, see, I think I've got another one. So here, the property that ended up being auctioned off, I wanted to see how good or bad a deal that really was. And we'll talk about how good a deal you can get at auctions in a second. I'm sure Charlie will have a lot to say about this part. But generally, at the first auction point, which is when it goes into foreclosure and it's auctioned on the courthouse steps, because there's 2 auctions that usually happen. This is the first of 2. Here, the bank is trying to recover what's owed on the lien, on the mortgage balance. So, if $400,000 is owed, but it's worth $425,000 and there's a second trust of $100,000, you're not necessarily going to get a good deal, which is why we have so many REO properties right now. REO stands for real estate owned. When the bank tries to sell it at the courthouse steps and nobody shows up, like nobody just showed up here, then the bank repossesses the property and has to try to sell it themselves as an REO property. And the reason we have so many REOs is because the balances, we've had all these loans where people were borrowing up to 107% of the value in 2005. Well, 107% of the value in 2005 is probably 120, 130% or more of the value now. So when they try to sell that on the courthouse steps, who's going to want to buy that trust? Nobody. So that's one reason that nobody's showing up, because I don't think the deals are that good at this point. So I did an analysis of the property. Now, I didn't have the unit number. It was a condo. I didn't have the unit number, but they were starting the bidding at, I think it was 235. And it's very hard to see this, but of the sold properties, one had sold for 227, 233, 240, 245, 255, 264, 267, and 280. So those were the sales in the past, I think, 6 months in that specific building with the same number of bedrooms and same number of bathrooms. So what that's telling me is that, first of all, the units on the higher floors were going for more, which tends to happen. So you have to discount some of the higher prices, usually by $5,000 or $10,000 per floor. So if they were starting the bidding at 235, I don't think it was that good a deal, because one property is sold for 227 on the open market. And there are risks with auctions. Let me just pause this here. One of the properties that this gentleman thought he was going to bid on, he had done his research, because you have to do a lot of research if you're going to buy these auctions. If someone is not paying their mortgage, they're probably not paying their taxes. So there's unpaid tax liens on these properties. The taxes follow the property, not the owner. So if that property is sold at foreclosure like this, you become the brand new owner of a tax bill. So the property that he thought he was going to buy had $6,000 of unpaid taxes on it. So there's risk here. If you're not doing your homework and you purchase one of these properties, you could be buying something that you don't know you're getting.
Also, you want to watch out for federal tax liens.
Sure.
Federal tax lien that the person owed on their income taxes that gets tied to that property, and you don't research it and know that, that can actually become your obligation as well, and those can be pretty extensive. And
one thing that I haven't gotten an answer on yet, I'd be curious to know if you guys know this. If someone's not paying their HOA fees, I'm sure that there's some kind of obligation there.
Absolutely.
But I don't know exactly how that process works.
I'm pretty sure that's considered a loss, because I'm in a condo building and they said that once it goes to foreclosure, they have to write it off as a loss, unless someone knows otherwise. I'm pretty sure that
It's
it
something.
gets dropped.
If anyone's curious about that, and we as a room don't know, then I'll be happy to research it, because these are questions that I'm trying to get answered. But suffice it to say, there's a lot of risk in these courthouse auctions.
How does one verify? I know how to go find, someone knows local taxes. How did you verify if someone has a lien from the federal government based on their personal tax returns?
It's tied to that property, like a title search.
Title search?
Yeah.
So everything that a title company usually does when a property closes, the settlement company, where, for example, Steve is from Monarch, they do those types of title searches in normal transactions. But you as the buyer have the burden and that responsibility when it's an auction. Steve, that might be an interesting business to get into, is doing those kinds of things for foreclosure and auction properties. Yeah.
I think the condo fees do need to be paid on a short sale, though. Like the condo can block a sale if they're a short sale if they're owed money. You can't just, they won't let someone sell it for $75,000 less and then be owed $5,000.
It's probably true, because in the bylaws of most homeowners and condos associations, they have the power to block the sale from going through. So since it's still the original owner, the seller that's selling it, I would imagine that those bylaws would apply.
So I imagine, I believe I've heard in the past that you can also, the HOA has the power to place liens on the property as well.
Yes,
unpaid HOA dues.
Depends on the bylaws of.
So if they were successful in doing that, that would probably fall underneath unpaid taxes as well.
Frank, that's something that is worth finding out. If they place a lien, then at that point would it follow through foreclosure?
I know that they said that they were worried about a certain percentage, because 14% in our building are not paying their condo fees at all.
Where's your building?
In Arlington.
Okay.
Virginia. It's 10 to 14%. It's a pretty large number. And I said, well, what if it goes all the way to foreclosure? He said, at that point, we have to write it off. And they did talk about placing liens, but my understanding was still that the foreclosure was kind of like a freeze everything in time and start from scratch.
Okay.
It's a high number of people.
Yeah. Washington Post had an article on condos having a hard time getting people to pay their condo fees, and those numbers add up pretty big.
All right, so let's move on. We've covered short sales. Everyone has a good idea of what a short sale is? Anyone not sure? I don't recommend short sales from a buyer's perspective, just because I don't think that the market is efficient enough yet. The banks are efficient enough yet at at answering questions and negotiating the contract. So once it gets foreclosed on, the bank tries to sell it at the courthouse. It doesn't sell. They take the property back, and now it's called an REO. I don't know why it's called an REO, real estate owned, bank real estate owned, but I don't know, that's the acronym. So I was looking for a good way to find these foreclosure properties, as I imagine you buyers that are in the room, and probably the realtors actually also, are, I don't know of any one, foreclosure guide. There are ways that you can find foreclosures through tax records, I imagine, but I was looking for an easy to search tool, and I couldn't find one, so we made one. We have a site called the Best Home Search Ever, or tbhse.com for short. And there's a little button here that says Search Only Foreclosures. So what you can do when you're searching for property is you can do a regular search. Let's say you search in Herndon, Virginia for 3 or more bedrooms. But then if you only want to find the foreclosure properties in that list, you can check this box. And we actually search the listing notes, because on many foreclosures, not all of them, but on many of them, the listing agent in the listing notes says, beautiful property on a ½ an acre, subject to third-party approval. So we search for bank-owned, foreclosure, foreclose, REO, third-party, bank approval, short sale, etc. in the notes. It's the only tool that I know of that can actually search the listing notes. And it's pretty powerful. By the way, you can also search for Metro. Many listing agents don't check mark the box that it's near Metro that they're supposed to when they're listing it, but they almost always say walk to Metro or blocks to Metro. So you can use this tool to search for any keyword, not just these, if you want to find properties close to Metro. But that's another seminar some other time. So
That's impressive.
this tool, yeah, so right now we're searching, I think, 93,000 properties. It's every single property that's in the MLS. And I have a connection here. If you guys maybe later would like, we can actually do a search so you can see what it looks like. Okay. Any other thoughts and ideas on how to find foreclosures? Because I haven't tried, going through tax records or anything like that, looking for where the property was sold back to the bank.
The Washington Post has a listing notice website where you can find upcoming foreclosures that are courthouse steps foreclosures. But as you explained, 95% of those never end up happening because the dollar amount, the starting dollar amount is too high. So that's another place.
And I know that also the executor, Samuel I. White, the attorney who handles many of these courthouse foreclosures, on his site, he also has a list of the courthouse auctions. So, if you just want to go to see one of these auctions, just Google Samuel I. White, and you'll find his website, or just email me and I'll send it to you. I don't know it off the top of my head. And he has a calendar of upcoming auctions. They handle, I think, the vast majority of the auctions for these banks. They have a lock on that.
Did you check, compare that with the Realtors track? Because they claim, the foreclosure is listing.
I have not.
Countrywide.
Yeah,
You
we.
could sign up for like 7 days, like free membership. After that, you can continue to pay for the membership.
One of the next things that we're going to do as a firm, Drodeo, we are starting to sell foreclosure properties for the banks now. So we're selling foreclosure properties for Countrywide, and we're getting involved with other banks. I'm going to try to create a site that's dedicated to not only these properties on the MLS, because we already have that, but then a lot of detail that I can get from the banks about the specific foreclosures. But that's going to take 6 months probably. And I'm sure there'll be plenty of other people trying to do the same thing. I mean, a lot of people are very interested in foreclosures. Every buyer that I talk to, not everyone, but many say, I want to wait. I'm not sure what prices are going to do, but if I could buy a foreclosure and auction property, I'd do that today. I mean, I have a lot of people saying that. And I don't blame them. Honestly, I don't blame them because we don't know what the market's going to do. Now, I think predicting the market is like, there's two types of prognosticators. There's those that don't know and those that know they don't know. I don't think anybody knows. It could stay flat. It could fall a little bit more. It could go up. But a lot of buyers are looking for deals right now, which is why we're here. Let me give you an example of a foreclosure that one of my clients just bought. Now, I do like foreclosures. Once it's an REO, I think they can be really, really great values. So if you as a buyer are interested in a short sale or an auction or a foreclosure, my recommendation, unless you go see Charlie doing one of his auctions, which we'll talk about those auctions next, but my recommendation as to the process that's most similar to what you're used to in buying a house on the open market would be to buy an REO property. Now, there are some differences. There are some big differences. One of the main ones is that almost always you have to buy the house as is, and with limited inspections, but you usually can inspect the property, and you do have many banks, in Virginia law gives you a right of rescission period, but banks also often give 10 days after an inspection. So you can inspect it. You can't ask them to fix anything, but you can jump out of the contract if you don't like what you find.
And I think you can time an REO, and it is still subject to, if there's a homeowners association, that you can inspect the documents. And in the contract itself, you have an out with the homeowner documents. So let's say you buy an REO, and you do an inspection, not expecting them to pay anything, but at least you've done the inspection and you do have the out with the homeowner documents.
Yeah, although the banks, I've found that the banks usually give a little bit longer. For example, I think, which bank was this? I can't remember which bank this was that sold it. It might have been Wells Fargo, but I think they gave 10 days. Here,
To do what?
to cancel the contract for any reason. So let me read this for you. This is a printout from Matrix, which is the search tool that Realtors have access to. This property right here, it's a 4-bedroom house in Herndon, originally sold for $639,000 on the open market in 2005. That was just the price. Nothing special going on. There were probably 10 bids on it, that sort of thing. Remember what that was like. So $639 in 05. The bank listed it at, where is it? $479. And this just closed several weeks ago. Hi, come on in. Go ahead and just grab a seat. You can grab some food if you'd like as well. And also, if you could write your name on a name tag, that'd be great. So the bank listed it at $479.9. We negotiated with the bank. We put it under contract for, oh, and by the way, before I get to what it sold for now, in 05, it was listed at $639. It actually sold above asking price at $645, but with a $6,000 seller credit. So it basically sold for $639, okay? You understand seller credits? The seller gave some money back to the buyer. So they inflated the price a little bit and then got a little bit of money back, okay? So the bank listed it recently, this was a month ago, at $479. We put it under contract at $455 with a $12,000 credit from the bank. So he basically got it for $443. So that is a big difference. It's a $200,000 difference in that neighborhood. There's a lot of owners that weren't too happy to see that happen, I'm sure. But the bank had to get it sold. And this is very typical to me. I have seen properties selling for $50,000, $100,000, $200,000 below what they were previously selling for just a year or two ago. So foreclosures can be very good deals, and they're fairly easy to execute.
But just for proper terminology, that isn't technically a foreclosure though. That's
The-
an
the-
REO.
the-
A lot of people use
yeah.
the blanket word of foreclosure.
Very true. Yep, it's an REO. It's a property that has been foreclosed on by the bank, i.e. the owners are out. It's always vacant.
Dan, how long did the bank take to get back to you with a signed contract?
Very interesting. So this bank, the listing agent actually went onto a website that she has with the bank, and she submitted the bid, and within 10 minutes they gave her an answer. Some banks take 48 hours to give an answer, but it's very fast. That's one of the reasons that I like it.
Yes, no thing.
They did counter. We made a lower offer. They countered with what we ended up taking. Yeah. Yeah, so it's a very fast process, whereas the short sale takes forever, the foreclosure doesn't.
Now, in that case, what does the bank do with the loss? I know they write it off, but how do they make it up somehow or what?
Well, the bank likes to get buyers who have pre-qualified through that bank so that at least they know that they're going to recoup some of it. But yeah, I mean, you see how these charges that banks are taking, if you read the Wall Street Journal at all. I mean, banks are taking big hits right now.
Merrill Lynch wrote down $8.4 billion the other day,
Yeah, it's just bad debt.
in bad mortgage loans.
So is it to the advantage of the buyer to make the loan application with the bank that's holding the
I would
money?
absolutely recommend, even if you don't plan on using that lender, that you do a pre-qual through that bank just so that they see that you do, that you are considering it. And, as you may know, just because you pre-qual with a certain bank doesn't mean you have to use that bank to actually do the deal. You can change the loan up to the day before closing. I don't recommend doing that, but you can. Okay.
I've seen some REO contracts that say that the seller, the bank, can back out of the deal all the way up to a day before closing. And some of the contracts are just so one-sided
Yeah.
and mind-boggling. And some of them try to waive the HOA rights, even though they can't be waived in Virginia, but they're they are contracts that were written for every single state.
Right.
But sometimes there's certain laws, such as not being able to waive the Virginia rules, that even if it's in your contract, doesn't make it so. But being able to back out of a contract up until the last day, you better read those contracts, because they are not usually the normal realtor contracts. There can be 10-page addendums that are required that they can back out and take another offer from somebody else all the way up to closing, which also means that realtors should look at bank-owned properties that are under contract, because they might be able to outbid the person all the way up until the day of closing.
Yeah, we'll talk about the outbidding thing in a second as well, because that's a big
I'm
piece.
not using the contract that I normally use with foreclosure.
Depends on the bank. You can use the standard regional sales contract, but always the bank will have an addendum or several addenda that are 5, 10, 20 pages long.
Negates the whole thing. It
Yeah.
negates your entire
And anything that's in the addendum overrides what's in the contract.
Well, if you have a buyer that is already approved, you can go to settlement within 4 days.
But here's the thing about banks. The banks, there's a couple things here. First of all, the banks don't have a mortgage to pay. They are the bank. So a lot of times I have buyers that say, I can close before the end of the month. Well, yeah, there are incentives for the bank to do that, but what you're dealing with is one person or a small department within the bank that is looking at all of these contracts, and they don't have the same motivations as a seller would. It's not like they have to sell their house so they can go be with their kids in Minnesota or something like that, right? So the speed, we offered to close more quickly, and the bank said, don't worry about it. It doesn't really matter to us. As long as you close by XYZ date, I don't care if you can close in 10 days.
And the opposite actually might be true, because if you have a quarter, if you're countrywide and your quarter's ending in a few days or in a couple of weeks, if you close on that property, it hits the books. If it doesn't close on the property, it hits the books next quarter. So it might be, and this the tricks that I'm trying to figure out, it might even be to their advantage sometimes to roll it over and extend it and delay the inevitable, just so it doesn't make their quarter look as bad. If you're a manager and you're trying to mitigate your losses, well, one way might be to not sell the properties. So there's
Yep.
a lot of variables.
And there's a lot, let me also give you some very honest feedback about realtors. Realtors need to feed their families too, right? So you're not going to see many realtors trying to help buyers with auctions at the courthouse steps. The reason that I went and took the video was because I'm trying to figure out a way to represent buyers through that process and get compensated, but usually the sellers pay the realtor's fee. The buyer doesn't pay it. So the whole realtor community doesn't have a lot of motivation to figure this issue out, right? With the foreclosures, they are getting paid. With short sales, that's a bone of contention, because often the listing agent will put a certain compensation into the listing, but then the bank will try to negotiate it because they're taking such a hit.
And then you can sue the listing agent broker for any difference.
Right. So it's
So
a very, but
negotiated.
you know,
You can go back and sue the listing agent broker.
full transparency here, if you're a buyer and you're looking for representation from a realtor, you just have to know that this is a very risky process, and you may be on your own for some of it. If you're trying to buy a property at the courthouse steps, there aren't many realtors that are, I would do it if I could make a fee agreement with the buyer, but what buyer is going to want to do that, and since you're buying these properties as is, I'm not the type of realtor that pitches, hey, you need a realtor. But there are a lot of things here where properties are in as-is condition, and these addenda can be very, very complex. So you just need to do your research and become educated about it. Hey guys, why don't you grab these seats here? We have a couple extra seats. Okay, so let's talk about bank auctions. If the property doesn't sell as an REO, the bank has to get it off their books, right? So then they try to sell it at auction. Now, Charlie, I don't know if you've been doing specifically bank auctions.
We did 644 auction transactions last year. We did 0 bank auctions. We do absolutely no foreclosures. We do all investor and owner auction sales.
So Charlie's auctions tend to be very good if you're an investor. Charlie has some amazing tricks and methodology to get these properties at auction for very reasonable prices. Now, with Charlie's auction, as with many auctions, there's buyer's premiums that are involved, and a lot of buyers don't understand buyer's premiums. You know, if you bid a certain price for a property, that's not the price you end up paying. You end up paying a premium above that of 5 or 10%. Depends on the auction company.
But you might be getting a 15 or 20%
Percent discount, right. Let me show you just real quickly here, see if I can pull this up. I have an example of a bank auction. This was at the McLean Hilton. Let's see if I can get this to play.
Welcome to Rodeo Real Estate Inc. Where full
I'm going to try to
service
fast forward through this a little bit. Again, the audio isn't great, but this is on this Jordy.com/auctions site. And it's right below, by the way, the courthouse auction, so they're both right here. But you can see there was a book with about 200 properties, and we can see what, like this was Washington Mutual, WAMU, and this was the auction. So this is much more of a traditional auction. When you hear auctions, this is probably what you think about, right? I didn't see any properties sell for more than $200,000 while I was there, Frank. I know you were there too, right?
Yeah.
You stayed longer than I did. Do you remember?
They were lower priced.
Many of these were condos, townhouses out west.
45 minutes away from DC, never anything closer. Anything closer usually sold before the auction.
Yeah.
It was sold before the auction. There was one in Arlington that did not end up getting auctioned.
Okay, so I'm not going to go through all this now, but you can see all the details here. Let's get back
Those ones that
here.
were selling for 100, 200, you feel like there were some good values and good opportunities in there?
They
or
were
were
so far away in the area that I don't know that it's hard to tell. If I were to guess, I would still guess it might be 20% off of what you might be able to negotiate on the open market, but then you have to add back in. I think they were doing a 5% premium, so maybe a 10-15%. But that's really just a guess. It was out of Manassas and Woodbridge.
My plug is dead here, so hold on one second. Let me see if I can plug in over here. Oh, is there? Okay, thanks. Thanks, Pierce. I appreciate it.
Hey,
Okay.
Charlie, this might be a good point for Charlie to give some tips on how he finds foreclosures. Charlie, besides running an auction company, runs an investor school and foreclosures and short sales. I'm sure a lot of your investors have been prospecting those for years. So can you speak a little bit to that?
One way is to do a lot of direct mailing. The law of averages, you're going to hit somebody who's 2 or 3 payments behind. And that way you can find who's actually looking for them and they find you. The other way is advertising. Advertising radio and TV. You get dozens of these. And another way is to do let's pay this file at the courthouse. I used to do that 25 years ago. I would be there just when the clerk, I'd sit behind the clerk before the ink was dry. That's when they did it by hand, of course. Before the ink was dry, you would just write down the addresses, and then I would take off to find the properties and knock on the door. Many of the times, the owners, the mortgage holders, didn't know they were foreclosure. Yes, you were foreclosure. And one of the packers answered, "Oh, that's what they do." And usually they say that about new law in Maryland. You can go to jail for 3 years and $10,000 fine for each incident. So what we do is represent them as an auctioneer. Say, let's beat the bank to the punch and sell the property before the bank has an opportunity. And if you use us, we'll actually market the property. The bank doesn't care. They stand in the courthouse like robots and they go through their legal procedure. However, we'll market the property for you. And we usually charge them a commission. Not just 15 to 20% on the transaction. But what we do, as soon as they sign our service agreement, is to call the bank, with their permission, of course, and tell the bank that we have been hired by Mrs. Jones, a mortgage lawyer with this account number, to sell their property at public auction. As a professional courtesy, we will hold off any more expenses until November the 15th. We're selling this property subject to your acceptance. So if they owe $200,000, we're standing there saying $100,000, they owe $50,000, now $75,000, $180,000, $185,000. Are you finished? So we sign the contract at $185,000, subject to the bank's approval. Call the bank, say, look, we have a cash offer for $185,000. That, in essence, is a short sale, and they respond a little faster with that. So we send them the HUD-1 and our cash contract for $185,000. And usually they will accept it, because what they know that they don't want to piss off the owner of that property. Because such things as putting bulk balls in the vent pipe, pulling cement down the commode, cutting the joints in half in the middle of the house. Banks don't want owners to do that because they're angry. So that method works very well when we're representing people who are in pre-foreclosure. So it's been real successful for us. And sometimes we give the owner a little kickback. I don't want to call it a kickback, but some of our fee, we call it a haircut actually, when we sell the property, so that they'll have moving expenses. We don't try to buy the property as a principal, we represent them. If it's not a full-blown foreclosure, then we will go ahead and buy that property. And sometimes do a hybrid or profit share, which works very well for us. It's a good closing method. We want to be at 150, they want to be at 180. Say, look, why don't we do 150? We're going to sell it in 3 weeks, and we'll give you a percent of anything we get over 150. So that's a hybrid profit share, and that works very well. So if we sell it for $200,000 and we're at 50% hybrid, they'll get 50% of the overage, or $25,000. So we make $25,000 plus the buyer's premium. So it works out pretty well.
I asked Charlie to make an RSS feed of all the auctions that they're going to be having, which is just going to mean that soon, hopefully within a couple weeks, on our site, we'll have a schedule of all the properties that he's auctioning just appearing on the site. And when that happens, make sure I get everyone's email today. I'll send you an email with that. So
And I've got a list of upcoming auctions
Great,
here.
great.
Now, I only have a few, and if you want to make some copies, you can have them. And we're here primarily to learn, of course, from Dan and the rest of the people around the table, but if you break it down and motivated by greed, you're here making money. Is that right? Okay. We don't want to hurt anybody. We want to be ethical and honest and make all disclosures. And what I suggest you do, and you can make money at courthouse steps. Banks are most willing. We have a foreclosure unit at our school in Investors United, and we have 2 attorneys teaching this, one from both sides representing owners and one representing the banks. And the one representing the bank is, I can't think of his name, Whitstaff. He said the last time he was there, he said banks are taking deep discounts. For instance, he told me one that the outstanding balance was $200,000, and he told this Mark Whitstaff, let it go at 140. So you don't know. Like, you need to do your homework, do your due diligence, attend all the auctions you possibly can, and attend the private auction where it's not a foreclosure, because you can find some great bargains. We always, when we look at property, we want to know what the reserve is. So if the reserve is $200,000, we hope that the property is worth a little bit more. We'll do our homework. And if it's not, we say, are you flexible? If we get 180, will you take? And they say, well, yeah, maybe. So when you go to the auction, and we're famous for taking haircuts, that's a discount in our commission. So if we sell a property for $200,000, our fee is $20,000 right off the top. But if we sell it for $190, and the owner says, or if we only get $190, the bid goes to $190, owner says, no, I need $200. Well, our commission at 190 is 19,000. We might throw in $5,000 or $10,000 to make the transaction work, and give it back to the owner.
But I'll tell you, as the buyer, whether it's an auction or not, don't be afraid to make lowball offers. You know, I always have buyers that say, I'm going to be embarrassed making this offer, but the reality is that that seller might just want to sell no matter what. They might be willing to let it go for a song.
What do you say at your school, Charlie? If you're not ashamed of the offer, then you're offering too much.
Yeah, what we say, if you're not embarrassed with your offer, you're offering too much. Steve Payne just offered $140,000 on a $400,000 property. Okay. And we sold it in 3 weeks and 11 minutes for $280,000, so we have $140,000.
Let's get Pierce on to talk about financing these types of properties. Pierce is a mortgage specialist, shall I say?
Sure, that's a good word.
So,
Thanks very much, Daniel. So my name is Pierce Cook. I'm actually with Wachovia Mortgage. Thank you all very much for joining us. Some of the things I just want to talk about, you know, there's a difference between the auction properties and the foreclosure properties, and probably the biggest question that everybody has here, and they ask me every single day, is getting this property, it's worth $400,000. I'm picking it up for say $300,000. I'm getting a really good deal, and you guys all know what the question is, right? I want to borrow based on the $400,000 because that's the value. Well, in the mortgage banking, there's a rule, and you only can borrow on the lesser of the purchase price or the appraised value. Now, the things I'm going to talk about to you today are a couple ways of potentially that you can actually, maybe if not immediately, but very close thereafter, potentially look to finance on the future appraised value. So, I'm not going to spend too much time about auctions because at auctions, as Daniel mentioned, you can't get access to the property. Well, if you can't get access to the property to inspect it or look at it for your own needs, I can't get my appraiser in there to give us a valid appraisal, which means that I can't lend you money until you have the ability to get in. Now, you know, Charles might be able to talk a little bit about that. If there's any opportunity to get into a property for auction, you may be able to then get bank financing. If there's some way to negotiate to get yourself in there, to get an inspection, then there's a possibility that we could actually give you a mortgage on that property for the auction if the terms allow you to do that. But more importantly, what we're talking about is the foreclosures. So if you're getting a property at foreclosure and you get access to the property, we could give you conventional bank financing on that, you know, based on 80, even 90%. Still, there's available investor loans of 90%. The most preferable way, though, and this is where it kind of becomes a little bit difficult, but you know, can you borrow money from friends or family? Do you have other property that you could leverage, get a home equity loan on for even short term? Because if you can figure out some way to settle on a property in all cash, all of your own cash, then, and you can prove to the bank that you're able to get this money either through home equity loan or borrowing from a 401k or any of these ways you could potentially get this money, and you take title of that property before having to place a lien on it, then there are loan programs out there where you can then come back and do a refinance and recoup all of your money back and are borrowing based on the LTV of the future value, of the actual real property value. Because you haven't used a bank to do financing on the property when you're first taking title, therefore you haven't actually kind of established that lesser of appraised value or purchase price because you didn't have to get the appraised value at that point. And it's difficult to sometimes get that money, but you know, I've seen people team up together. I've seen people call friends, call family, you know, do any way they can to go settle on this $200,000 piece of property, or $400,000 property for $200 or $250 or $300. They're able to write a check, and then they can come to me and look to do a refinance loan, recapitalize themselves completely, and have this property. Now, it's unlikely you're going to get any more. So if you buy the house for $300, it's really worth $400. You're able to pay cash for $300. Then you come back to me and say, well, hey, you know, you're letting me borrow based on $400. I want to borrow 90%. You're not going to be able to get, you know, more money than you put into it. Some instances you are, if you have a very strong mortgage application, maybe able to put a second mortgage on there. But most likely you're going to be able to get a loan for what you ended up paying for out of pocket. Okay? So if that's not possible, which it may or may not be depending on your level of access to capital, the next step is to look to take down a traditional conventional mortgage loan at a point in time when you're able to go on, you know, on this foreclosed property, when you're able to actually go and buy it. So that's going to be, you know, maybe an 80% loan on an investor loan. We still have a bunch of different interest-only options. You can even get the 90% through an 80-10-10. I don't recommend taking one loan to 90% on investor property because you're going to have very high mortgage insurance. You know, and so there's a couple different reasons not to do that. But let's just say you have to take conventional financing. Well, the usual rule for Fannie Mae and Freddie Mac is that it's going to be a year out until you can actually use the new value. Well, at Wachovia, we have some portfolio loan programs that are our loans. We give the money out, so we make the rules. So those loan programs are actually going to allow you to, within 6 months and a day, use the new appraised value. So depending on how many properties people are looking to buy, if just one or two, then 6 months and a day from you taking title and owning that property, you can come to a bank like Wachovia and you can get one of our portfolio loans that gives you borrowing on the new appraised value with only 6 months and a day. So that's pretty quick period of time. And if you do improvements and things and really increase that potential value, then at that point, if you can document that you've done improvements, we're going to even lend more than what you had already purchased for. So you bought it for $300, it was worth $400. You've done some improvements, maybe it's worth $425. Your new LTV can be based on $425, and then you can even borrow more than that $300. So you could recapitalize yourself, and you could get additional money out for having other needs. One of the other things I really recommend, and other question I get is, can I buy the loan? Can I buy the property in an LLC? I don't want to hold it myself. I want to buy it with a group of people. The rules around that are very, very complex, and the way I would recommend is talking to someone like myself and figuring out exactly how you're going to structure your LLC. It needs to be very closely held, usually only 1 or 2 people. Usually they need to be related. So everybody in this room today couldn't just sign a paper and say, hey, we're going to create an LLC, and we're going to put documents together, and then Pierce is going to give us loans from Wachovia. Okay? I wish it would happen that way. There are some banks out there, some smaller banks, and they may not be doing it much anymore. I know a couple years ago it happened all the time. People get together and do that kind of a thing. But you can actually buy an LLC. It changes a little bit of the loan parameters and programs that are available. They may not be marketable, saleable loans to Fannie Mae, Freddie Mac. They may be more of our portfolio loans of 5 or 7 or 10-year ARMs. But buying an LLC has a lot of benefits of it over buying in your own name, especially if it's going to be long-term investment property that you're going to rent. So the final thing I wanted to talk to you a little about is the portfolio loan that we at Wachovia, I really think is the best loan to have an investor. Being that this loan you can take 6 months and a day after taking title of property and use new appraised value and even get cash out. And this loan, you've heard a lot about option arms. Well, it sounds like an option arm, but we've got a lot of different variables in there that help protect you. So being able to defer interest, negative amortization and deferred interest is the best thing you can possibly have as an investor in my mind, because I'm allowing you to take a piece of property that you're hopefully going to, I believe in right now is the time to buy and hold on and not necessarily try and flip and sell to make your money as an investor in any of these properties. So if I could show you a way to buy a property, all right, maybe you fix it up a little bit, get a renter in there at reasonable market rent, but be able to take a loan on it where you could defer some interest. If that property starts to appreciate at only 1.5% to 2% per year, and in 3 to 5 years when the market really turns and things are on a roll again, you're able to watch that loan balance slowly grow, but the income you have coming in on that property is guaranteed enough to make the payments on the loan, probably enough to create a little bit of cash flow. But if the property goes up only 2% per year over those years, you're actually, in this scenario, going to be making equity on the property. You're going to still maintain a positive equity growth position, but you've created cash flow and you've been able to hold this property. If you follow this methodology, you could have 3 or 4 or 5 properties, because on your credit report and on your mortgage application to buy these properties, you're not going to be cash flow negative, because when you have an investor property, you're only allowed to use 75% of the monthly rental income to offset the mortgage payment. Well, with these loans, because of the payment that shows up is so low based on the minimum payment, you're actually going to be able to show positive cash flow and be able to take down more properties than you would with conventional financing. So if you have an interest in trying to roll together, I have some people that have 8 and 10 and 12 properties, and they're coming to me now saying, hey, when this foreclosure boom really happens in the next 6 months to a year, how many can I get? Well, we need to start early looking at the types of loans that we have, because there's a certain point where, whether or not you're doing it in an LLC or you're doing it individually, that you have no more capacity to borrow money within reasonable rates and reasonable terms, because your debt to income ratios are maxed out. So there are always loans out there, but the best possible loans are the ones that give you the good interest rates and the low carrying costs in order to have flexibility as these properties continue to evolve. Does anybody have any questions about any of that?
Yeah, doing these loans with you, is there any time frame that you have to hold on to the
Yeah, that's going to depend on, if you decide to take a loan that has prepayment penalties, you're going to want to obviously hold on to it until those penalties are up.
No prepayment penalty.
With no prepayment penalty loans, you're going to be able to sell them whenever you'd like. But you are going to pay a little bit of a higher interest rate, based on the type of loan. And I would recommend also, if you're looking to only hold properties for 3 months, 6 months, I'd recommend don't care about interest rate, look at fees. Look at the fees. I'd rather see someone take an interest rate of 7, 8, 9% on investment property and not have to pay any origination points and maybe get a credit back from me at closing. To be able to not have to come out of pocket with as much money, because your carrying costs may go up a little bit, but for 3 to 6 months it doesn't really matter.
Do most of your loans as a default have a prepayment penalty? Is that pretty much the default? And then if you wanted to go outside of that, it costs a little bit more?
No, I mean, we have everything. We have every single type of loan, from your standard 30-year fixed to an option arm, hybrid arms. The ones that are going to give you, the portfolio loans, it's called the pick-a-pay loan, where it comes in 2 different flavors. It's variable or it's fixed. It has a 30-year fixed rate with payment options, or you have the variable rate, which is tied to our own index, not tied to LIBOR or MTA or anything that's really volatile. It's tied to the Wachovia Cost of Funds Index. And those loans are going to have prepayment penalties. You can buy them out by taking a little bit of a higher margin or a little higher rate. But those are the loans you're going to take when you're looking to buy and hold. Looking to turn them into a rental, because right now, if you can get properties at a deep discount, is it realistic to think that you're going to turn around and sell them on the open market because you put paint and carpet in them and get the number you're looking for? But I would propose, what's the risk in holding a property if I'm giving you a loan where your monthly obligation is at a 1.95% 30-year payment rate, and you can defer interest? And everyone always says, oh, I don't want to defer interest, it's horrible, it's the worst thing possible. As a real estate investor, that's the absolute best thing possible, because I'm controlling your monthly costs. And if you could rent these properties, get a year lease, and I'm even looking at some investors right now who are renting these properties to people at less than market rent. So if the house should rent for $2,000, they'll get someone in there who'll give them $1,800 quickly, because that one extra month at $1,800 versus $2,000, you've made $2,400 up because you rented 1 month before. And that's one thing that a lot of people I've talked to. They're always trying to get the highest rent. Rent it quickly, maybe even take a little bit of loss, but on the loan, that payment's going to be so low, you've just bought yourself a whole year of potential appreciation. So if you can get 3 or 4 properties, get them rented, put them on these loans that give you financial flexibility and let you defer some interest, then 3, 4, 5 years down the road, I believe that those portfolios will have gone up 10, 20, 30% above what you bought them for, but above the actual market value now. Question?
Are these commercial loan products or these residential loan products?
Residential loan products.
So you're residential, you're not
residential, exactly. We do have commercial loans available. Have a whole commercial division, but you're not going to have as much flexibility on those type loans, because they're going to be really based on current cash flow or on your individual personal financial statements.
Are your loan program allow transfer of title to LLC, or that will incur due on sale costs?
Well, you can transfer your title to LLC after the fact on most loans without really having to worry about it. You usually maintain a dual title, so you own it with the LLC. But some of the loans talking about, you can actually buy it in an LLC. So you're going to sign the bank note and the deed with both you and the LLC, but then the LLC will actually take the loan out in their own name. So you're not obligated. The LLC and you are both obligated, but it gives you the protection.
And if we buy it with cash, initially, how soon would we be able to get a loan?
Based on the actual market value, immediately. Take us a couple weeks to put the transaction together. Because you haven't actually used financing to take the property down, there are loan programs that are going to let us use the new appraised value. The one caveat in that is that the appraisal is going to have to show that you did buy it at a deep discount. So the appraisal should indicate when we're doing the refinance loan that the property was bought at foreclosure and the estimated market value based on comparables is this, and there was a discount of so and so. So we have to have some sort of reasoning behind why you got for a big discount. Because people have tried to come and say, oh, well, I bought it from my dad or my brother, and that's not an arm's length transaction, so that doesn't quite qualify. That may be saying what the real market value was, but when there's reasoning behind, like a foreclosure, and we can show that the real market value is X, then we can use that market value. Okay? Anybody have any other questions right now?
You mentioned some loan programs that the mortgage payment is kind of tied to the rent, 75% rent. I'm not too clear.
Well, when you're taking out a conventional mortgage loan, putting together an application, and you have rental properties, okay, the amount of rent that you're collecting, all right, if someone's getting you $2,000 a month, excuse me, we're only going to let you use $1,500 of that to offset whatever mortgage you're going to take. Okay, so when an investor has 2 or 3 properties, and they, let's say they have a 9-to-5 job making $100,000 a year, and they have their primary residence, and they have a couple of investment properties, maybe a car loan or credit card. When you look at their debt-to-income ratio, a lot of people come to me and they say, hey, look, I have a $2,000 mortgage and I have a $2,000 rent coming in. Boom, I'm good. Well, no, really, you have a $500 a month loss based on when the bank looks at it. So looking at some of these loans that give you opportunity to defer interest and have cash flow and have a lower monthly payment, when I take that $2,000 and discount it to $1,500 and say that's what I can use to offset corresponding mortgage payments, but my mortgage payment on this loan I've been talking about is only $1,395 or $1,250, you've got $250 positive cash flow, which you can then use to offset a potential another property.
From the bank's perspective.
From the bank's perspective, exactly. So it has nothing to do with how you're going to repay the loan. It has to do with how you can qualify to carry more. Because if you don't have relatively okay credit and a job where you're earning income that you can show, then we can certainly use stated income programs, but the prices are going to start to go up because you have to show capacity to repay, and the capacity to repay, if it only comes from that asset, then we have to make sure that you have other resources if you were to have trouble. Okay. Anybody else?
On 30-year fixed interest only, what kind of premiums do you guys charge versus just regular interest and principal?
The difference on those loans is probably about a quarter to 3/8. I mean, it's going to depend if you're going full doc, stated income, full doc, and then based on LTVs. But usually about a 0.25% premium to have the interest only added on there. But the loans I'm talking about, like for example, our pick-a-pay loan, Wachovia purchased World Savings about a year ago. It was about a $25 billion transaction that we bought them. One of the reasons we bought them is because they have this loan. They've been doing it for like 20 years, and they do it the best out of everybody. And the reason they do it the best is that the appraisal process is very strong. They look at the borrowers, they look at the credit, and they have kind of they look at the whole transaction, not just any one piece. They've done a great job of looking at what loans to take and not take, but also they have a couple of checks and balances in the loan that doesn't let you defer too much interest, that doesn't let you borrow too high of an LTV. So when it fits, if you can get that loan, it's something you can keep confidently for 5 to 7 years, know exactly what your payment's going to be, know that it's not going to recast because we have 125% recast balance versus most other people have 105 or 110. And taking a 30-year fixed rate, the premium on that loan to have the different payment options compared to your standard 30-year fixed might actually be maybe 1%. But I could show you that if you're looking at it from investment purposes, the opportunity for cash flow and to be able to take on 1 or 2 more properties. If you're just looking for 1 or 2 properties, you can take traditional financing. If you're looking to get to the point you can take 3, 4, or 5, unless you have a huge 9-to-5 income, then you need to look at these loans that help you create a little cash flow so you can leverage yourself a little bit more.
And by the way, for primary residences, I assume you must have a loan like this, Pierce. There's a loan that I really like, which is a 30-year fixed rate, but the first 10 years are interest only.
Exactly.
So your rate doesn't change, but your payment changes in year 11. So if you're going to live in a house for 31 years, you want to pay that off because you don't want to have a mortgage in year 31, right? But if you're only going to live in the house for 2 years or 5 years or 7 years or something like that, you don't necessarily want to be using your cash that you've earned, you spent a lot of time earning, right? To be putting into the house to pay down the payment, pay down the principal a bit, just to then take that money back out when you sell it. If you can just pay interest for those first 10 years, you have the protection of having a fixed rate for 30. It gives you some flexibility, so your payment is lower for the first 10 years. Then it goes up a lot in year 11, because they have to amortize the loan down. But for the first 10 years, you're only paying interest. It's not a neg am. You're paying all the interest due, but it's a very popular loan.
Well, especially what's going on in the real estate market when you see that prices have come down a little bit, and there's other places you can put your money and diversify yourself. 2, 3, 4, 5 years ago, it was, my real estate's gold, it's going up 8, 10, 12% a year, everything's perfect. Now things have changed. I'm a big believer in why pay the bank back their money? I mean, I work for a bank, so I'm sitting here telling you, why pay the bank back their money and lessen their risk when you can borrow at 6, 7%, keep that money out. I'm a big fan of paying less than interest only and using that to leverage myself, to buy other investments, to buy real estate, things that could potentially grow, because paying the bank back their little bit of principal every single payment for 360 payments doesn't really do you any benefit. You're putting the bank in a golden position, and you should be out for yourself. So, there's a lot of different schools of thought, but I've been doing this for 10 years. I actually owned my own mortgage company for 4 years, came back to Wachovia recently, and there's a lot of different methodologies out there. Not saying any one is best, but just looking at standard loan programs is not going to allow you to do things that are going to put you to the potential that you could own many properties. And I'd rather have $2 or $3 million of properties that can grow at 5 or 10% a year, maybe even 4% a year, than 1 or 2 properties at 350 or 400, because that you start leveraging yourself to that point and you can handle it, you're going to be creating a lot of wealth very quickly.
Just one quick thing, Rich. One caveat is that Pierce and I definitely drink the Kool-Aid. I mean, real estate is our life. So you might not all have that risk profile. Obviously, don't do anything you're not comfortable doing. But
absolutely.
What Pierce is suggesting is an aggressive strategy that does allow you to, like Charlie likes to say, control and roll. I mean, you're controlling these properties with minimal cash in your own pocket.
Your world savings option arm product, I'm assuming you can't do that for an LLC held property, can you?
Oh yeah.
Okay.
Yeah, that's the dream. The difficulty in LLC becomes when I can't. First of all, an LLC, an alternative titled property, is not a marketable saleable loan. So it has to go on a bank's portfolio. So it can't go Fannie Mae or Freddie Mac or FHA or VA or any of that stuff. It has to go in our portfolio. So we have a couple different loan programs, 5-1, 7-1, 10-1s. You can do that. The portfolio pick-a-pay loan is absolutely an alternative title, and that one even has more flexibility than the 5, 7, and 10-1 ARM products.
And for cash out on that, do you get cash out in a lump disbursement, or do you not get cash out, or how do you allow cash out?
If you're getting cash out, you're going to get it at settlement table 3 days after your rescission period expires, and on investment property there's no rescission period, so you're going to get it right there.
Right there. Okay. Because I know that Wachovia, just give a plug, Wachovia has really cool programs, and so I didn't want to necessarily bring it up because you only do residential, but on the commercial side, if you have an LLC property, what we did was we actually used the LLC property as collateral and opened a business line of credit, and that allows you to have a revolving line to use your equity to go in and out and fix projects up and do it over and over again, as opposed to getting one lump disbursement that you now have to pay on even when you're not using it. So you probably want to talk to Pierce about finding someone if that fits your profile on the commercial side, because that's a commercial product.
That's a great point.
They will use your property and your collateral to open business line of credit for you, and you can use that for investment purposes.
Well, let me take that same kind of topic, and if you're thinking about being a real estate investor, you are a real estate investor, if you own any real property, whether it be, a primary residence, any investment property, if you don't have lines of credit on all of those things today, you need to get them, because that's the absolute best place to borrow money from. And even if you never use it, I mean, pay the $300 or $400 or $500 it might cost for an appraisal fee and closing cost. Talk to this man right here; he'll be happy to hook you up with them and get them open and in place, because you never know in the next opportunity to buy a piece of real estate or invest in a stock, or it's just you have to have access to it. And this is the next in my mind, the next best place for short term is have credit cards, and have credit card balances, limits available of $20,000 and $30,000 and $40,000 and $50,000. Because you might just need that $20,000 pop to get your next house fixed or to get your next thing done. And having to come to me to say, hey, I need to do a cash out refinance for a first mortgage to get $20,000, I hate when that happens. It's because it costs you $2,000, $3,000, $4,000, $5,000 to do a cash out refinance to get 20. That's 25%. That's crazy. But I see you'll do it all the time. The time to get money is when you do not need it. And I have people that call me, young people call for the first day, hey, I'm going to buy my primary residence. I've been saving up for 3 or 4 years. I've got 20% down. I want to take a loan for 80%. And I bang my head against the wall trying to tell them, please do me a favor. Let's put down 5%. Let's take an 80, 15, 5. And the day you go to settlement, you're going to take all my money. And then a day later, you're going to go to the bank and pay down the line of credit. Okay? So you pay it down, so you have one loan for 80%, and you have a second mortgage for up to 15%, and you have 5% into it on the day of settlement, and then you have 20% into it the day after settlement, just like you originally came to me for. But if something happens and you need to borrow that money, you can stroke a check. Oh, but I don't want to, or my wife might do this, or my husband is going to gamble. If people, they have to be financially reasonable and understand that if you don't, responsible, reasonable, everything. If you don't need the money, that's the best time to get it. So if you're thinking about buying investment property, buying foreclosures, and you have an opportunity to get a line of credit, you have credit cards, that sounds crazy, but having this, 5-10 years ago, mortgage people might have said, oh, you can't have all this outstanding revolving credit. The rules have changed now. I personally have access to $125,000 to $150,000 on credit cards. Okay? I haven't had to use it because I haven't come across the greatest opportunity yet. I have an investment property. I have a $125,000 line of credit that is to 100% LTV. Okay? But it has $0 on it right now. So if I wanted to buy one of these properties to go do something, I personally come up with $250,000 like that. Just like that. But I've been preparing for a long time. I haven't had to use it too much, but those are the types of things you can look to do to get yourself to a position where you can buy a property for cash and be able to come back, just 2-3 weeks later and recapitalize yourself based on the appraised value.
How did you do the investment property 100% LTV now?
It was no. I'm a pre-planner, so I used to live there.
Oh, okay.
I lived there, and then I refinanced it and put that line of credit on there, and then I bought another property, and I'm getting ready in the next 6 weeks, if everything works out, to do it again, and keep on rotating that through. And before I do that, on my primary residence now, I'll go take out a new line of credit, try and get it up to as high as I can. Rules have changed. Getting to 100 might be difficult, but 95 shouldn't be hard at all. And then I'll have access to it. I may never use it, but I'd love to have access, when I'm done in a couple years and end up in my, $2.5 million primary residence. On all of our properties, have access to all of the equity in them at all times.
Can you talk about the risks involved so we can get a full picture for people that are considering doing this? The option arm can be fine, and I've always said debt is your friend if you understand it. But can you talk about how when you have 3 or 4 properties, if 1 month, if a renter moves out for 2 months and you don't have that extra cash, how that can just be a snowball tumbling?
That's why I'm not necessarily always concerned about interest rate on the loan as I am concerned about the payments on the loan. Because if it creates cash flow for me, I may not, like on these option arms, I may not make that minimum payment all the time. I may make like my full rental income. And I have investors that do this. I say, look, you can take this, you could make this payment, but unless you don't need cash flow, take the full rental income you have coming in and pay the payment on the loan. Okay? But if they move out, if you run into hard times, you can drop down to that payment. And that's a great point. I mean, you have to have, if you're going to have 2 or 3 or 4 properties, you have to have those other lines of credit, the other option to carry yourself for 2 or 3 months if things go bad, damages happen. You have to have the full insurance you can possibly have on every single property. I mean, there's a lot that goes into this. But the risks, I think, are far outweighed if you're responsible and you understand how this is done. I've certainly sat down with people who I didn't feel were going to be fiscally responsible, and I'm not going to give them all the expertise that I developed over the years and help them do something I think is going to get them in trouble. I may explain to them some of the potential opportunities or maybe the ways it can be done, but I'm not going to offer somebody who has had credit problems in the past and doesn't have that capacity, the ability to do these kind of things. And with anybody in this room who's interested, I'm going to sit down, I'm happy to sit down with you personally and go over your portfolio, yourself. You got to look at your credit, your income, your assets, and put it all down and figure out if you have the capacity now, great. If you don't, where do you need to go to get the capacity?
Okay, just real quick, it's about 1:20, I think. I know that some of you might have to leave early because you're doing day jobs, I understand. But before anybody goes, if you could please write on the back of this name tag your email address and phone number so that I can email you a copy of this presentation and also Samuel I. White's website and all that good stuff. And then just put those here, okay? Anyone who doesn't have one.
And I'll put a stack of my business cards and give them out if anybody wants to call me or have any questions. I mean, this is what I do. I'm actually also, full disclosure, a licensed real estate agent in Maryland and Virginia. So like Daniel said, I live it and breathe it, and I really believe in it. And I like helping people. as well.
Can you give some examples for a client that came down on hard times or whatever, just so people see what a scenario that can happen? I'm assuming that you don't have 100% of all your clients that never had problems, that someone is going to have lost their job or just some examples of what problems occur.
Unfortunately, I guess fortunately for me, but unfortunately, I don't really hear a lot of that stuff. I mean, I have a core group of clients from when I ran my businesses before. I've heard a couple of things that have happened. Divorce is a bad one, loss of your job. But, the last 3 or 4 months, 6 months, the markets have really changed. The stories get worse and worse. I mean, people losing their job and they're getting foreclosed on and they can't make their payments. I mean, I have a really good friend of mine down in Florida who I helped him get his mortgage on his property, and he's been trying to sell it for a year. He cannot sell his property. He's called the bank and said, a lot of things that Dan talked about. Deed in lieu of foreclosure, short sale. I mean, it's not pretty. But a lot of the people that I've dealt with in the past, I can honestly say there's only a handful that have gotten into situations, and none of it really has been because I put them in loans that couldn't happen. It was other forces. Loss of job, divorce has been a big one I've seen happen, and very few people. I find that most people understand their risk tolerance, and they're not going to extend themselves to the point they don't have an out. If any poker players in the room, you always got to have your out, so you can't be drawing dead. And if you are, then somebody didn't advise you the right way.
Any difference between obtaining the line of credit between your residence versus investment property?
Huge differences in the loan to values that you're allowed to go to, as well as the premium you're going to pay. So on your primary residence, you're going to be pretty close to prime. On investment properties, you're going to be at prime plus a margin of anywhere from a half, depending on LTV, up to as high as 3, 4, or 5. But again, it really needs to depend on what you're going to use the money for. If you're going to use it short term, quick hits for a month or two for 20 or 30 grand, the rate's not as important. If this is going to be something you're going to pull out long term and hold for a year or two, I don't recommend using lines of credit for financing much longer than a year or two without some sort of plan in place to decide when to repay it. Go ahead.
And again, Wachovia has lots of cool products. If you have a business entity, sorry for the business thing again.
No, it's fine.
It's been around for 2 years. Wachovia has an unsecured business line of credit with a summative credit score. They don't check anything. They just check your credit score, check your entity, give you a line of credit. So if you are in that position, you should apply for that because it's a pretty cool product. And
it goes back to the thing: have access to capital as many sources as much as you can. Friends, family. I mean, if you're gonna do this, you have the capacity to create that LLC, and maybe you have a friend who has a lot of equity in the house, and you really believe in the deals you're going to be coming across here in the future. Find access to capital.
Chris, could you speak to the how the Fed cutting interest rates is going to have a different impact on prime rates as opposed to long-term mortgage rates?
Sure. I get the call every single time the Fed meets, and rates the rates go up, rates go down. The last 2 ones, thank God, have been down. But I say thank God. Actually, sometimes when the rates were going up, when they had, if you look at the chart, the Fed has just taken it up and now they've dropped down. The mortgage rates have really nothing to do with what the Fed does. So the Fed's doing short-term interest rates. So when they dropped that 0.5% in a September 18th meeting, mortgage rates actually went up because people were coming back to buy the securities, and the price of a bond is inversely related to its yield. So as the price of a bond goes up, the rates come down. Okay? Well, as the price of the bond goes down, the rates go up. Well, when the Fed dropped the rates, people that own bonds said, oh, you know what, we're going to sell because then the equities are going to go up. So as they sold their bonds, the 10-year bond, the yield on the 10-year bond actually went up. So 30-year rates and long-term mortgage rates are actually tied to the 10-year bond. So when the rates, everyone called and said, hey, it's time to refinance. I said, actually, rates went up today. Well, what do you mean the Fed lowered the interest rates? You're crazy. Well, you guys are the only bank out there. And then if you go do the research and look at the 10-year chart, you can see that it actually went up. So, it's not necessarily tied. But it did lower. So the Fed lowered by 1/4 point. That lowers the home equity rates. So, prime has gone from 8.25 to 7.75, and now to 7.5. And the bank will follow with a cut in their lending prime rate in another couple weeks. Yeah, usually the banks always base their lending rate on the published prime rate in the Wall Street Journal on the 26th of the month. So the Fed meets, and then the banks will kind of trickle down over the next couple weeks.
So by the 25th, you should see a reduction.
Absolutely, across the board.
Let's get James Brennan on.
Sure.
to talk
Thank you all very much.
Thanks.
And I'll give you some cards if you have any questions.
And Piers, if you could actually pass your microphone.
Oh, sure.
So James is 1031 attorney. How many of you have heard about this? Thanks.
Thanks, Daniel. Well, I'm like with some politicians. I try to surround myself with smart people. And Pierce and Daniel definitely know their stuff really well. You know, I couldn't speak to some of these foreclosure topics or, you know, mortgage topics in my wildest dreams. So I'm really kind of a, you know, have been for the last couple of years a one-trick pony. I've done about 300 or 400 1031 exchanges, and it gives me a really good helicopter position above the forest to get a glance on what investors are doing. Can I get a show of hands how many of you are investors or are realtors representing investors here for foreclosures and auctions, not necessarily primary residents? So it's a good number of you. You know, Charlie, what did you say the typical foreclosure incidents were? Putting a golf ball and where and something with the commode? What are the typical problems?
Well, yeah, you know, if you put a tennis or golf ball in the vent line, you can't flush the hose because it doesn't get air and it just spills over the place, or pouring cement down the commode to block the main line.
See, these are the things that keep my wife up at night. If we were going to shop for foreclosures for our primary residents, most of the people here are either looking as investors or representing investors who are buying foreclosure properties. The idea of buying a foreclosure property or property at auction for your primary residence, for those of you risk takers in the room, you're like, oh, that sounds like a great deal. But for the average, you know, family, it probably makes you a little queasy. So, you know, the great thing about dealing with investors, which, you know, 99, 100% of my clients are, they're investors, they take calculated risks. They're not very emotional buyers. They don't, you know, drive up to the property and say, oh my God, they painted the shutters green, and then just keep going. They make calculated risks. And for 1031s, the things that I've seen, you know, investors look at their property collection or the portfolio as a portfolio. And now's the time in this environment to kind of rethink your portfolio. What I saw about a year ago was people change their asset allocation from residential condos in Northern Virginia. I'm going to get out of those things and I'm going to get into a commercial property. So if they own 2 residential condos for $500,000, they were into that $1 million commercial property. But what I'm seeing lately is, especially with this boom of opportunity for the investor clients, is all of a sudden they're coming back. The ideas are coming back from land, $1 million worth of land, into 2 foreclosure properties. $1 million commercial property into, you know, similar short sales. So, you know, the great thing about the real estate industry, it's inherently opportunistic. You know, there's always an opportunity there. I know on the media it plays up, you know, a ton of bad things. A lot of them are primary residence related. But for the investors out there, they're happy. You know, this is great. They're the grave dancers. That was Sam Zell, the commercial, you know, real estate mogul. He's the grave dancer. Somebody's suffering, but he's out there, you know, tap dancing. And so 1031, for those of you in the room, how many of you have worked a 1031, represented a client, done a 1031? And Charlie's one of my clients, so I know he's done it. So I know you guys have all done exchanges. For those of you who haven't done 1031 exchanges, it's the provision of the Internal Revenue Code that relates to deferring capital gains. And, you know, there's 3 buckets for real estate. There's your primary residence bucket, which is covered by Section 121, your normal $250,000, $500,000 exemption. Okay? There's 1031, which covers investment property. And then there's your other bucket, which is like vacation homes and second homes, and they don't really qualify for each. So you usually get people pushing it to 1031 or pushing it to 121. And the provision that Daniel likes that I use in some of my slides is Internal Revenue Service Code Section 1031 is one of the single greatest wealth building tools available to the real estate investor, allowing you to defer the payment of capital gains taxes when selling an investment property and exchanging into another. Okay? A deferral. Again, I'm in the same boat as Pierce. When people talk to me and they hear stuff like option arm, there's words like deferral, and it just, again, makes people think it's something wrong. Deferral, my mother always taught me, pay my debts when they're due. Don't put them off until later. Well, the great thing about 1031 and the tax provisions is you can, what they call, swap till you drop. You can defer that capital gains liability until you pass away, and as Pierce described, you have that $2-3 million real estate portfolio, heavily leveraged, and your cost basis goes up to the fair market value at the time of your death. So the number one reason people do a series of 1031 exchanges is because it's a deferral that can be delayed inevitably. Okay, so it's a swap till you drop, defer, and die kind of tool.
Does that make sense to everybody? Because that's really powerful. Like if you buy a place for $200,000 30 years ago and it's worth $2 million today, if you were to sell it, you would have to pay taxes on that gain of $1.8 million. Unless you've been doing 1031 exchanges through all the properties that you've bought and sold. And then when you pass away, your children, their cost basis is not $200,000, it's now $2 million. So it's not exactly, but basically that. So they don't have to pay taxes on that gain. Now, if it goes up in value while they own it, then they will, but they can also do the same thing. This is, the rich get richer kind of thing, this is how it works.
It definitely is a wealth building tool, and since this is kind of the one field that I play in, I kind of get isolated to this. So the two guys before me were really speaking in economic terms. I kind of live in the tax world, which operates in the tax world, which is kind of a different language. And I'd be happy to discuss that with you and your clients. As far as getting listings and going out there and getting listings, this can be a great prospecting tool, because a lot of your clients will think they have to pay taxes when they sell that investment property, and it's a great time to recalibrate their portfolio. I just went down to Fredericksburg, was helping a Keller Williams agent down there. She was selling a $400,000 property that didn't cash flow, and her personally, the realtor personally, she was selling it, and then she was going to buy two townhouses that cash flowed great in this market. So again, it's a great tool when you couple it with the other products that we're talking about. The other thing that I wanted to talk about is refinancing the replacement property. 1031, the IRS has designated the settlement of a property as a taxable event, okay? But a refinance is not a taxable event. So when I see people sell one old property and exchange into a new property, so they take $500,000 of cash and buy, those two foreclosures, I always tell people one of the best strategies besides swap till you drop is refinance those replacement properties. Pull that equity out, okay? Because you're avoiding, as Charlie would say, taking a haircut from the IRS. So even worse than taking a haircut from your auction broker is taking a haircut from the IRS, because that's about 15 to 30%, and they're not really doing anything for you. They're just taking a piece of the pie.
What I discovered with the 1031, I've done a lot of them, is that you can sell your property for less, and you can actually pay retail for a replacement property, because you're saving so much money in taxes. And the realtors here, if they could explain that to sellers, say, you can take less if you do a 1031 exchange, and of course if they take less, you're going to sell faster and get to the commission quicker. So that's a benefit that's not often talked about, that you're saving so much in capital gains taxes that you can sell your property for less and still come out ahead of the game.
Well, we're technically deferring, but I mean, it's the same thing in the end if you keep doing 1031. So if you have a $500,000 gain, your tax hit is going to be about $150,000, 30% of your gain. That's a lot of money. So what Charlie's saying is if you do a 1031, you can afford to sell it at a little bit of a lower price because you can defer those taxes. You don't have to pay those taxes.
And when investors understand that, they will rock and roll. You can find your portfolio. I got a beautiful home in Florida, thanks to Jim, that I identified a day before my 45th day. So it really is great. We control the property. We bought a property for $500, sold it for $880. Steve Payne and I, we each went our different ways in that replacement property. So 1031 is a really great if you understand.
For the example that you gave, like 500,000 property and you bought two of the 250, correct me if I'm wrong, I read somewhere that the property that you are buying is supposed to be at least the same price or higher than the price that you then the capital gain that you get?
Yes. So not even just the capital gain. It has to be, it's called trading equal or up.
Yeah.
So if you sell for $500,000, it's really value for value. So if you sell $500,000 worth of value, you have to replace it with $500,000 worth of value. So you can have two properties that add up to $500,000. So you could buy multiple replacement
But
properties.
it doesn't have to be one property.
Does not have to be one property. A lot of my clients will go into 4 or 5 properties, and even it gets into a longer seminar. It's normally 2 or 3 hours, but they often in that scenario use not the 3 property rule of identification. They use what's called the 200% rule. But great question.
We do have a lot of that information online as well. So.
There's a timing thing.
Yep, 180 days from the relinquished property closing to the replacement property closing. For those of you who really are opportunistic and know exactly the property you want to buy and your property that you're trying to sell is on the market, you can consider also the reverse exchange, because then you can close on the replacement property and then you have 180 days to relinquish the old property. Okay, the reverse exchange is the exact opposite. The regular delayed exchange is you sell your old property and you have 180 days to close on that replacement property. That's the standard, what's called starker or delayed exchange.
But I know what I want to buy.
And yep, if you know what you want to buy and you close on that, say December 1st, and you want to close and you have a contract for your old property, but you know it's not going to close till December 15th, you can do what's called a reverse exchange, where the intermediary goes on title for you. You need a certain type of exchange financing called reverse exchange financing. Wachovia can do that. But you can get the property you want, and your property that you're selling is going to be on the market. The reason why a lot of people don't do it, number one, the financing tends to be a little bit more expensive, and number two, it's a costlier transaction. The average 1031 exchange is $500, $750. Reverse exchange is $4,000 and up.
Why would you do it?
Most commercial investors do. Because if they really want to buy a certain asset, say I want to buy a strip mall in Herndon, and that strip mall is kicking off a great rate of return. It's got a Starbucks in there. It's got a Giant, and that hasn't been on the market for 10 years. If I can get that, and I know, and I can't sell my office building in Reston, and that's going to close 60 days later, they'd rather do a reverse exchange, get the asset they want, pay the $4,000, because to them that $4,000 is really a rounding error.
That doesn't pay for residential.
Well, it depends on what you're dealing with. Georgetown, Adams Morgan, those types of areas, the juice is worth the
Or you're
squeeze.
getting a deal if you close in 15 days.
Yeah.
If part of the terms is closing fast.
We had a client we had a residential client that was with had $1.2 million, and it was almost to his advantage. It was a residential deal. I mean, and it was almost to his advantage to do a reverse exchange because he was dealing with such a large capital gain. So if it's a certain timing and your gain is say $800,000, and you know exactly what you want, it could be worth it. But if you're dealing with a $200,000 foreclosure out in Spotsylvania, it's probably not going to add up. The math isn't going to work for a reverse exchange. Well, I could take all these types of questions afterwards. I know you guys are here to learn about foreclosures and auctions. If you guys have any questions, feel free to ask me, because this is, again, I'm in the tax world, and a lot of these opportunities are mostly in reality over here. And this is all kind of, like phantom income kind of stuff. The tax language.
Somebody had a question. Let us know.
The other thing that I want to speak to is I am integrated with the wealth management group. So, as Pierce alluded to, we really underwrite the individual when you start dealing with wealth management type of things and commercial types of assets. And that's where they look at the business or the person's assets. So you can start doing some interesting things if you have good income and you have good assets. You can start, using your stock portfolio to collateralize. If you have, say, $7 million in a Charles Schwab account and only one property, you can start doing some creative things to come up with lines of credit and different things from that platform in Wachovia. This is the time to leverage your banking relationship. Bankers 2 years ago were commodities. They were vendors. You can get banking relationships anywhere. But now that bankers are back to being conservative underwriters, they're really your partners. Bankers are becoming your partners, and unless you're good to your partner by holding deposits there, investments there, they're not going to bend over backwards to make some sort of exception loan for you. So, there's a lot of things Pierce and I encounter on a daily basis that are right in the gray area. The bank can do it, and we couldn't do it. We're not going to bend over backwards for somebody who's not moving their $7 million investment portfolio from Smith Barney and isn't doing their lines of credit with Wachovia. So Wachovia is only going to bend over backwards for, people they have relationships with. They're here to build relationships.
On a 1031, if you have partners in a company, when you sell the property, each partner gets a portion of the 1031 proceeds? Is that how that works?
That's a great question. And what type of entity would they be in?
Like an LLC, and there's 4 of us in the LLC. If we sold something, we each get a fourth of the gain.
That's a common question. If they're in a joint member LLC, if you plan to co-invest together, that LLC can stay created, and you can keep that partnership. If you were reporting it on a K-1 or any type of partnership return, you can go and co-invest. That's kind of what Charlie was talking about earlier. He was co-investing with a gentleman in an LLC. It was called Payne Parish LLC. There was a joint member LLC, and what happened was they didn't want to co-invest. They wanted to break apart the partnership. And what you do there is you go to a Monarch title and you retitle it in advance, and you go into tenants in common ownership. If you go into tenants in common ownership, it's going to give you that flexibility to go separate ways. And if you go into tenants in common ownership, that's called a drop and swap. You're going to drop from an LLC joint member into tenants in common. If you do it in advance enough, say a year before the property sale, you can then go your separate ways, and you can all co-invest to your monetary value. So if you own a property together, $1 million, Charlie was selling an $880,000 worth of value. Him and his tenant in common co-investor each did an exchange for $440,000 each. So does that answer your question? That's called a drop and swap. But in that joint member LLC, if you're registered in that joint member LLC and it's on the title that way, you're going to have to co-invest in that same fashion, because partnership interests aren't exchangeable. That's the reason why, is because you can't have a partnership distribution. I have a guy right now who thought he was going to do a 1031 exchange. $18 million asset, multifamily property, him and 2 brothers. The brothers are redeeming his interest. If they owned it as tenant in common, they could have bought his $6 million interest from him, but instead they were just going to give him $6 million. That's a partnership redemption. He can't do a 1031, so he's going to invest with Wachovia in the securities side of the piece. So, I mean, that's what I see all the time. Instead of, people find out they can't do a 1031 in that fashion, because in that situation, the other brothers didn't want to sell. They just wanted to redeem the owner. If they were in tenant in common, they could have just bought his interest. But because he didn't have a saleable interest, he just had a partnership interest that redeemed. It wasn't exchangeable.
So I didn't realize that Charlie was coming. It's great that he's here. And so I don't have a slide from Charlie, but since Charlie is here, Charlie runs an investor school up in Baltimore, and maybe you can take 10 minutes and you can talk a little bit about some of the things that you do, because for any people who seriously want to be investors, he's the one to talk to. Like, more than just, I have 1 or 2 investment properties. If you want to be a serious investor, Charlie's the person to talk to.
And if you're from Baltimore, Charlie is a celebrity up there. He's on television, the radio. I heard him on talk radio. So I'll turn the table over. The school's great.
Yeah, unlike a celebrity, they don't have to pay for that, but I do. Yeah. No, it does pay. It does pay to advertise. It really does. We have Investors United School of Real Estate. It's a 2-year program if you sign up before the end of the year. So that means you're with us for 2 years, 24-hour access to computers and mentors and everything else. And it's investorsunited.com if you care to go look at it. And our sister company is Auction Brokers. It's auctionbrokers.net. And I just have a couple. You can pass those around, take a look at them, and maybe somebody make you copies if you want to come to the auctions. And I can guarantee you that you can get bargains at our auctions. And we have a program called the $100,000 formula. It's called buy low, sell low, and do it often. And if you're doing that, you're going to do it often. You don't need all of the juice in the orange, in the deal. If you're buying a property and you're turning it over quickly and you're doing it often, you're going to turn it over quickly if you're selling less. The other thing we have is called a control and roll. And I invent all these things. Having lived to age 65, I guess you keep thinking and say, gee, how can I cut this corner? How can I create something? How can I make more and work less? And that's what I like to do. So we have the control and roll. And a control and roll is that we'll go out and control a piece of property, and we teach our students how to do this too, how to control a piece of property and then roll it within 3 weeks. We usually say 3 weeks and 11 minutes. That's how fast we want to sell it. Now, we're selling properties we don't own. We're controlling it. And who's married here? You know what control is, right? Yeah, okay. So that's the same thing. You control the real estate. For instance, if we go out and control a piece of property for, as Steve Payne did, for $140,000, the property was listed for $400,000. He made an offer of $140,000. The guy said, I'll take it, because he was going into foreclosure, the roof leaked, and the tenant wasn't paying. So we took it in 3 weeks and 11 minutes to public auction and sold it for $280,000. So he made $140,000 equity profit right there on a property he didn't own. Nothing against banks, but why go borrow money? You're only borrowing money to buy a property, resell it again, resell it before you have to borrow money or before you own it. So that is a control and roll system, and it works great. We did 644 transactions last year, and you can do it right here in this community by wholesaling. Find a property and make sure you put the proper clauses in. And the clauses would be that you have a right to market the property by private treaty or public auction anytime before settlement. And it is contingent and subject upon third-party assignment. What a great contingency. In other words, if you don't find someone to take this property off your hands before settlement, you don't have to go to settlement. So you make all your disclosures, you have a right of possession or access. That means that you can move in if you want. You can go in and paint the property. And during that period of possession in your contract, you can turn around and sell that property through public auction. The other thing you want to do is delaying tactics. A delaying tactic is rather than using, say we're going to go to settlement November, December the 24th, we say, well, we'll settle within 60 days. I'm sorry, 60 banking days. So how long is 60 banking days? Can you help me with that?
It's about 5 years.
About 3 months, okay? I just controlled a property, 43 apartment units in southwest Baltimore County for 5 months. And we're in for $3.2 million. And if I sell it for 3.1, I'm okay. You know, I mean 3.3, I'm okay. If I sell it for what I bought it for, then I still make $300,000 off the buyer's premium. So think auctions, think about turning properties over, and think of auction brokers. And I'll leave some cards here if you want to sell properties. We go anywhere in the country to sell properties through public auction. And it's a great method. There's a number of properties, auctions, methods. Dan was that one as a courthouse step. That's a for sale, that's a foreclosure. The other one Dan had on the screen was a ballroom auction. A ballroom auction where you're in a room like this or bigger, and you flip pictures of the properties up and you say, all right, who gave me $100,000? I'm making $150,000 now too. It's sold. Next one. And last year we sold like $2 million in property in about 3.5 hours at a ballroom auction. So it's a great way to control and roll and make money. Dan, you mentioned something about, and I just made a couple notes, who would pay an agent to represent them at a foreclosure. We have a program called Fiduciary Buyer Broker, and a great thing for agents and investors too is to pay an agent to represent you, and that's a fiduciary. Now that means that you as an agent are listing the buyer rather than property. So you go around and list buyers, you get a retainer fee, and you determine exactly what they want and then go out and find that property. All right. Now basically an investor wants what? They want a pretty house with purple shutters? No, they want what? Tell me. What do they want? They want a profit. That's all. And if that profit comes from the ghetto or a very elite neighborhood, it doesn't make any difference. So when you list an individual says, well, I want some foreclosures. All right, and what is the profit term? What profit margin do you want? So Dan goes to the courthouse, he writes letters, he finds a property, his client wants $15,000 profit potential, there it is. So Dan will write a contract to buy it and then take it to his client. As a fiduciary buyer's broker, he can do that. So that client will probably buy 5 or 10 properties a year because he's doing what he does best, maybe working for Wachovia Bank in an office somewhere, you know, in a penthouse, while Dan is out there buying properties for him subject to his approval. So you can do that. That's the fiduciary buyer brokering. And making offers, and we always say make offers all the time. Do you have to see a property to make an offer? Heck no. We just bought a property, offered to buy a property, 320 acres in Newark, Vermont for $160,000. All I'm doing is flipping that property. I will never look at it. I figure somebody will pay me $180,000 for it, so I'll make a couple $1,000s on that. So you don't need to see a property to make an offer on it. We talk about trial offers. Whatever they want while on the telephone, if they want $200,000 after building rapport and asking a certain question, we say something, Mr. Seller, you know, everybody, realtors and owners, always price their house property higher than they expect to get. Is that right? And you do this over the phone, you know. Yeah, well, that's right. So you will take less for the property, sure. Now, if I could come over this afternoon, make an all-cash offer, no commission, no settlement costs, would you take $180,000 for the property? You want it 200, you make an offer on the phone, $180,000. Do you need to know the comps? No. But what you need to do is get to the baseline very quickly. They have several prices: the price that it's listed for, the price that they will take, the price they'll need, the price they will take, and the price you make an offer. And that's about wholesaling. When you make those offers on the phone, you can do 10, 20 offers a week if you want to. It's not going to cost you anything, you know. And then put it in writing, go out, make it subject to looking at the property. You would be surprised. Especially, you wouldn't be surprised, actually, in this market, there are so many people who want to get out. And you would be surprised the hit they will take. And somebody talked about today, I think, Pierce, you talked about it, people will come to settlement with $20,000 because they want to get out of that property. That $20,000 is a benefit to you because that is a discount that you're going to be making. Yes, ma'am.
For the wholesaling offer, like do you use the standard offer or you just use letter of intent?
No, we use a real offer. We call it a skinny. We have a skinny contract. Realtors hate it. They really do. And they don't know how to respond to it because it's one page. That's why we call it skinny. You know, I only need one clause in there, a couple clauses. Right to market by public treaty, right of possession or access to the property, and delayed settlement clauses.
And usually you don't really need to put earnest money for those kind of offers.
Well, you put some earnest money on. We have a way where you can actually buy or make offers on several $1 million worth of real estate with very little. I always carry $100 bills with me, and I give them a $100 bill, and that's my deposit. Whether we go to settlement or not, I carry contracts too, they're in my pocket. And whether we go to settlement or not, they can have the $100 bill, I don't care. But I put a second deposit in the contract of maybe $10,000 or $15,000, any number I want. Somebody says, I don't have any money. I said, well, you have blank checks. He says, yeah, well, you can use those. You see? So you just write a check, and the check's no good until sometime in the future something happens, such as the approval of the title or the lien report. So that check is just sitting in where's the title company guy? Did he leave? Yeah.
I'm sorry.
Okay. If I gave you a check and it says, do not cash this deposit check until we approve the title, you're going to hold that check, are you not? Okay. Now some title companies, they get confused and deposit. They're not supposed to do that. Okay. So we actually have probably several $100,000 out there in deposit checks being held until such time we approve the title. But we do still have the $100 good consideration. So you can control many, many millions of dollar properties by using this method. And this is what we teach in the school. And we also teach ethics, to be honest, be upfront, be moral. Don't try to take advantage of anybody, because if you do, it's going to sneak up on you. So to make money at public auctions is go control properties and then sell them at public auction before you have to go to settlement. Why go to settlement? Why borrow money? Sorry, Pierce. Why borrow money? If your intention is to flip it and make money, control and roll the $100,000 formula, well, just go ahead and flip it. I mean, you can make $50,000, $100,000 a month if you know what you're doing, and that's what we teach, InvestorsUnited.com. And again, the 1031 exchange, that is a great way to increase the quality of your portfolio. You can go to Baltimore and buy garbage, junk property, put a little fix-it-up into them, and sell them all subject to a 1031 exchange, and buy a strip center, a shopping center, a nice house in the county.
You said your course is 2 years?
It's 1 year, but if anybody enrolls before the end of the year, we give them another year. And they have 24-hour access. You can come in 3 o'clock in the morning if you want.
Do you do anything in Virginia?
We are franchising our school. We will eventually get to Virginia, Washington area soon. Our next franchise is going to be in Philadelphia.
What's the cost of your?
$12,500. $12,500. For you, you're a realtor, $15,000. Yes, ma'am.
Sorry, when I'm coming in the door, I don't know whether it's you, if we are making an offer and we are not ashamed of that offer, it's you're offering too high.
Yeah.
And
No, if you're offering too high, you ought to be ashamed of yourself.
Okay. And I kind of don't know how to weigh the fine line between don't take advantage of other people and offering low.
You're not taking advantage of them. You're doing them a favor. We have one student in the school, and we have to laugh at him. I think it's a little ridiculous what he does. Whatever they want, he offers 50% less. You know, you want $100,000. I want $100,000. We'll give you 50. You know, sometimes they say yeah, but sometimes they say, well, I can't do 50. I do 75. Then your trial offer is successful.
You see, and we call it a trial offer. And if they get mad on the phone, what do you mean? You're going to offer me $50,000? Hey, don't get excited. It's just a trial offer. I'm just testing you. You know, you just tell them, I'm just testing you. What will you take? Well, I'll take 75. Okay. You save $25,000. That's what you want. And then you take it right to public auction. And there you are 3 weeks later. $100,000 to make it 110, now 20, 30, 130,000, make it a 40, 140,000. Sold. So he's in for 75, sold for 140. How much did he make? 60 and 75. Right.
The question that you're asking is what all of my clients ask, which is, I'm going to be ashamed to make a really
Don't be ashamed.
It happens all the time. So you're not alone in asking that, because many people feel that way. What I've found is that you never know the sort of situation. There'll be two houses that are for sale next to each other, and one seller might not have to sell for 6 months. They retired. They just want to move down to Florida whenever. And the other seller needs to sell yesterday because family member died and they need to go take care of their mother in California. And you have to consistently make these offers over and over again until you find the seller that really wants to sell. And sure, you might find some people who say, no, get out of here. But you're not doing anything wrong by doing that, because there are sellers out there that really need to sell.
Yeah, and that's true. And you're not going to find them until you smoke them out. Because realtors are always so protective. My client wouldn't take that. What are you making a decision for him? Shut up, you know. Just go see the client. You know, the realtor, knock on the door. The client wouldn't present my offer. He wouldn't? Well, I'll take that.
And realtors are required to...
What are you laughing at?
Even if the realtor doesn't think... even if the realtor doesn't think they take it, you still have to pay it off.
Yeah, but they don't. They're supposed to, but they don't. Yeah, my experience has been the opposite. Sometimes they say, I'm not even going to present that offer. Well, I will myself.
Charlie,
Yes.
what I'm doing right now with my offers is I am going to the seller with the listing agent and we're presenting them together.
Well,
I'm not.
that works if you can get the listing aid. Pierce, you mentioned something I wanted to comment on, getting into a pre-foreclosure house so that you can get a tentative approval on it. The best way to do that for the investor is talk to the mortgagor, the owner of the property, and say, listen, I'm sorry that your house is being foreclosed, and I hope you can get out of it, but I intend to bid on that property at public auction. Now, if I happen to buy that property, I'd be willing to give you X number of dollars for moving expenses, but I need to get a loan. So if you cooperate with me, sort of be my partner here, let my appraiser, my banker get in to the property, I'll go to the courthouse steps and see what we can do. So that's one way if you educate them that way.
Could you talk a little bit about the law in Maryland that they recently changed? I've heard a little bit about it, but I haven't got the exact scoop on it.
Well, they're given their seminars on it. It came about a state trooper's widow was tricked into signing a deed, and they had emergency legislation, and many states are adopting the same law, that if you go buy a property and you sell it within 18 months, you're required to give that owner 80% of your profit. Yeah, 80%. If you don't do it right, if it's not the right size font, if you don't get it notarized, if you don't do a half a dozen other things, the Attorney General can have you physically arrested and incarcerated for a long time and fined. And they're out there headhunting now for people trying to take advantage. Everybody thinks foreclosures is a great way to make profit, but it's an emotional way to make. I started doing foreclosures many years ago, but I wouldn't do them today other than representing the owner. You can make a lot of money in foreclosure, you make a lot of money in real estate, but in Maryland you've got to be very, very careful with foreclosures. And one of the best ways is just to make that seller your partner. Do not ever rent back to them, okay? Okay, I'll buy your property, but you get out before settlement. Don't ever get in bed with that seller who is in foreclosure, because you're going to get in trouble. All right? Anything. It's just like a drowning man. They'll pull you down, or a drowning woman. They'll knock you down. Okay? Any questions? Because I've talked about enough here. Yes, sir.
1031 exchanges when you're flipping properties. Isn't there some rule that
Flipping?
If you're buying places for $300K and selling them for $400K within a month or two, or even before you close on it,
You would probably not qualify for that. Yeah. I'm kind of marginal now because we flipped the property in 3 or 4 months and did the exchange. Won't tell anybody, okay? So as long as I'm not audited, I'm okay. And my company allows me to use my home in Florida. They let me come and rent it,
General rule here, James, you can speak to is 1 year.
The rule comes
there's nothing in the, in the law about this. Congress and the Internal Revenue Service tried to get together and pass a law for a year and a year and a day, but it's a facts and circumstances test. So that's why there's successful exchanges that people have been only owned property for 10 months, and there's been exchanges that have been disallowed where people own it for 13 months.
Yeah.
So it's a facts and circumstances test. Are you declaring that income on your property? Is it showing up like investment property, or are you taking a depreciation deduction? Those are going to be the types of things you're going to look at. Did you take a personal loan out? Did you take a business loan out? Did you take an investor loan out? There's a lot of people out there taking out residential loans to buy investment properties. One of the exchanges was disallowed for 13 months because the guy was using a residential loan and he wasn't treating it like an investment property on his taxes. So, just treat it like an investment property and have that trail, and then if you ever got voted it would be disallowed.
Yeah, and you do need that trail. And Pierce, you mentioned credit lines, and good for you. My credit line is just under $1 million. I'd like to increase it, get a couple more. And the great thing about a credit line is that you don't have to go jump through hoops or beg a banker for a loan. You already have it. You just write a check. Okay, you're your own bank. You write a check. I recently wrote a check for $500,000 to buy a property on the Eastern Shore. The opportunity was there. It was worth about $750,000 or more. But had I had to apply for a loan, the opportunity would have been gone. Wrote the check. Bingo, now I own a house on my own bank. But I'm paying my credit line back. And when we flip the property, I'll pay it back and plus have a profit. So credit lines are great. If you don't have one, go get one. And same thing with credit cards. When that opportunity comes, it's not going to wait. You need to jump on it, write the check, and do the deal. And thanks for the time you allowed me, Dan. Any questions? Okay. And if anybody wants a business card, you can have one. And,
All right.
and for asking questions, here's $100 for you.
Thank you.
So we've been in here for a while. I hope it was useful, valuable stuff. I think the main thing that I would like